Welcome back, traders. It's fantastic to have you with us again. In the previous videos, we've covered foundational topics to prepare you thoroughly for live trading. To quickly recap, in video 1, we walked you through setting up your brokerage account, ensuring you're fully ready for options trading. In video 2, we discussed essential terms and concepts such as delta, theta, strike prices, and expiration dates, equipping you with the fundamental knowledge needed for successful trading. In video 3, we explored your trading environment in detail, learning how to use platforms like TradingView and Thinkorswim effectively. We also analyzed various indicators, including MACD, Supertrend, Volume, and VWAP, helping you interpret charts accurately. Today is particularly exciting because we're diving into live trading scenarios, using real-time data and situations to help you gain practical experience. Our trading scenario today involves NVIDIA, NVDA, which has an upcoming earnings call scheduled for Wednesday. Earnings calls frequently serve as significant catalysts, often causing notable movements in stock prices. Given this event, we anticipate possible upward momentum and will therefore approach trading puts cautiously. While dollar cost averaging DCA is a valuable strategy for adjusting positions back into profitability, our primary objective today is to close all positions by the end of the trading session. A critical reason for this approach is that options trades settle the following trading day. This means any capital invested today won't be accessible again until tomorrow. Let's begin by examining NVIDIA on our TradingView platform. First, ensure your price axis is properly adjusted to avoid exaggerated stock movements. Next, verify that our essential indicators are active: MACD, Supertrend, Volume, and VWAP. Observing overnight activity, we see significant upward movement during the European trading hours, signaling considerable buying strength, likely due to anticipation of NVIDIA's upcoming earnings call. Now let's transition to our Thinkorswim mobile app and look closely at NVIDIA's options chain just before market open. Notice there is minimal activity visible until the market officially opens, after which comprehensive data on options will populate. The dotted line on the options chain represents the current stock price, clearly aligning with various strike prices. Observe how the delta value improves as an option moves closer to being in the money, or when the strike price nears the actual stock price. Calls gain delta value as the stock price rises, while puts gain delta as the stock price falls. For today's exercise, our focus is primarily on trading with a modest account size of approximately $2,000, aiming for a daily profit target of around $50. This target demonstrates practical and achievable goals suitable for most traders starting with similar capital. Let's explore a practical example. Suppose an option is priced at $5.15. Remember, one option contract represents 100 shares, making this option's cost $515. If this option has a delta of 0.4645 with a strike price of 136, and NVIDIA stock moves from its current price of $134.01 to $135.01, the value of your option would increase to about $561, yielding a profit of $46. Our goal today is to safely achieve a $50 profit. To mitigate risk, we might execute multiple smaller trades throughout the session until we meet or surpass our profit target. For traders with larger accounts, the profit goals scale accordingly. For instance, aiming for $500 daily with a $20,000 account or $5,000 daily with a $200,000 account. Now that we've established our strategy, we're ready to execute our first live trade and continue learning by real-world example. Let's dive in. Let's go ahead and buy our first option. After reviewing the overnight market activity, we can see a clear upward trend developing for NVIDIA. Specifically, our volume indicator shows that the red or selling phase is weakening, suggesting a decrease in selling pressure. Although our Supertrend indicator still indicates a higher count of sellers, our RSI, Relative Strength Index, has started leveling off, signaling potential stabilization and upward movement ahead. Based on this analysis, we are opting to buy a call option rather than a put, as we are more confident in the potential for upward movement at this time. However, don't worry if you initially chose differently. Remember, we'll be discussing the powerful strategy of dollar cost averaging later, which can help mitigate risk if your trade initially moves against you. For today's trade, we're selecting a call option expiring on June 6th, which is next Friday. Typically, we prefer options that expire the following Friday or further out, providing us at least a week and one additional trading day. This buffer allows ample time to use dollar cost averaging effectively if the market temporarily moves against our position. We're targeting an option with a strong delta, meaning it has significant sensitivity to price movements of the underlying stock. Our chosen strike price for this call is 135, aligning closely with NVIDIA's current price momentum. Let's pay close attention to the option's bid-ask spread, currently at $0.20. Ideally, we want to purchase this call at the lower end of the spread, around $5.50. Using a limit order helps ensure that we don't accidentally buy at the higher end, potentially saving us from an immediate $10 loss due to the spread. However, if we notice rapid upward momentum and feel confident in capturing the price movement immediately, we may instead use a market order. This type of order instantly executes at the current market price, beneficial in fast-moving scenarios. By filling our order quickly, a market order can ensure we fully capitalize on strong momentum without missing potential profits while waiting for our limit order price. With our strategy clearly outlined, let's proceed confidently and execute this first trade. Make sure you adjust the action in thinkorswim to buy. The default is typically set to sell, so double check before placing your order. Here it is. This is our position. Our market price is 5.70 and our trade price is also 5.70. That puts us at zero profit and zero loss for now, which is a clean entry. In thinkorswim, you'll see your position marked in the options chain with a small green flag. This is how you know you're currently holding that contract. Now let's take a closer look at some of the important metrics on this position. One of the most important metrics is theta. In this case, our option has a theta of 0.30. That means if everything else stays the same and the stock price doesn't move at all, then by this time tomorrow, our option will have lost $30 in value. Think of theta like an overnight holding fee. It's the cost your option pays just to exist another day, like the nightly rate for a hotel stay. Theta represents time decay. As the expiration date approaches, this decay accelerates, slowly draining value from the option until it's worth zero on expiration day, unless it's in the money. This is why it's important to balance theta with delta. Buying an option with a very high theta and a low delta is often a losing battle because you're losing time value faster than you're gaining from movement in the stock. Luckily for us, our position has a theta of 0.30 and a delta of 0.50, which is a solid balance. This means that for every $1 the stock moves in our favor, the option gains $50 in value. Plenty of strength to offset the overnight decay. Now let's go ahead and identify our entry on the TradingView chart. We'll mark this with a long green line to represent our call entry, green for calls, just to keep things visually organized. Try to place this line at the price point where our option becomes profitable, though keep in mind that exact profitability will shift slightly depending on delta changes, which are governed by gamma. To the right of the screen, you'll also see a live feed of our options market behavior compared to side by side with our charting indicators. This is where the real-time interplay between stock price and option value becomes clear, and where you can start to develop a deeper intuition about how options move. It's a great idea to also use a text box to identify each position. Labeling them clearly on your chart helps you keep track of which trades are active, which ones are approaching profitability, and which ones may need adjustment. For instance, mark the exact candle where you entered the position and note the trade price. This gives you a quick visual reference for monitoring progress. Here on our chart, you can see that at this specific candlestick, the market value of our position is about $5.40. Since our entry price was $5.70, we're currently down around $30. While it's never ideal to see red right away, This isn't a cause for concern. We made this trade based on solid indicators and a thoughtful strategy. In trading, mindset and methodology are everything. We'll dive deeper into mindset in an upcoming video, but for now, stay confident. We're sticking to our process, and that's what matters among them. Now let's focus on what our indicators are telling us in real time. We can see that the red volume bars are shifting from weak red to a slightly stronger red and back to weak red. This type of pattern often signals that the selling phase may be nearing its end. That would be excellent news for our call option, because if the buying phase that follows is strong enough, it could lift the stock price and push our position into profit. Sometimes the sell-off trend is so clean and consistent that we can draw a straight trend line or arrow right across it, useful for visualizing when a reversal might occur. Now let's look at the VWAP, the volume weighted average price line. Right now it's still trending downward, which tells us we aren't quite out of the woods yet. This ongoing downward pressure suggests we may have jumped into our call just a bit too early. In fact, a put might have given us short-term gains here, but that's okay. Trading is about adapting, and the important thing is knowing what to do next. We see the stock price is approaching VWAP -2. Remember, this is where we often observe the rubber band effect, a natural pullback zone where prices tend to rebound. And encouragingly, the VWAP line is starting to level off. Take a look at the RSI indicator at the bottom of the chart. It's beginning to change direction, curling upward, another sign that selling pressure is weakening. Meanwhile, the red volume bars are also becoming lighter and shorter in size. All of these factors together point to a possible momentum shift, and that's exactly what we want to see when holding a call option. Now that we're starting to see upward momentum and the signs of a trend reversal, things are looking brighter for our position. The red volume has softened, and we're no longer seeing strong selling activity. Our VWAP is beginning to level out, suggesting price stabilization. This could be the beginning of a shift into a buy phase. This brings us to an important concept: dollar cost averaging. This technique will play a crucial role in your trading toolkit. Let's break it down. Right now, our call is approaching the right momentum to go into profit, but we don't know exactly how high the stock price will climb or how quickly. Instead of relying on one perfect entry, dollar cost averaging lets us reduce the amount of movement needed to reach profitability by spreading our capital across multiple entry points. The idea is simple. If the price drops and we still believe in the direction of our trade, we buy another contract at a lower price. This lowers our average cost per contract. That means the stock doesn't have to rebound all the way back to our original trade price to make a profit. It only has to rise enough to meet the new lower average cost. This approach is powerful because it helps mitigate losses from imperfect timing and allows us to take advantage of market fluctuations more strategically. And as you get more comfortable with this method, you'll find it gives you the confidence to stay in trades longer and make more calculated decisions. To understand dollar cost averaging more intuitively, let's use an analogy. Imagine you're in a store buying sacks of flour. You believe the price of flour is going to rise, so you purchase one sack at $10, hoping to sell it later for a profit. But then the unexpected happens, the price drops. Now the same sack of flour costs only $5. Rather than panicking, you see an opportunity and buy another sack at the lower price. Now you own two sacks, one at $10 and one at $5. Your total investment is $15 spread across two sacks. That means your average cost is $7.50 per sack. So now, instead of needing the price to climb back to $10 to turn a profit, you only need it to rise above $7.50. This is the exact principle we apply in trading. When we dollar cost average into our options, we're not just reacting emotionally to a dip. We're making a strategic decision to lower our break-even point and give ourselves a greater chance of ending the trade in profit. Now let's apply that concept to our current position. The call we initially purchased was priced at $5.70 or $570. However, the current market price of the same option has dropped to $5.32 or $532. That's a $38 discount from our original purchase price. If we still believe in the upward trend for NVIDIA, this is a great time to apply dollar cost averaging. By purchasing a second contract at $5.32, we reduce our overall average cost. Let's calculate it. $5.70 plus $5.32 divided by 2 equals $5.51. That means our new trade price, our average cost, is $5.51. We now hold two contracts, and although the price difference between our trade price and the current market price is smaller, any movement in our favor now impacts two positions instead of one. A 0.01 change in value now results in a $2 gain or loss instead of just $1. The same strategy can be applied even during more extreme drops. While we don't typically recommend dollar cost averaging too early or too often, this example demonstrates how powerful it can be when timed well. Usually, we prefer to see a price drop of at least $1 or $100 per contract before considering additional entries. Of course, the decision to dollar cost average depends on several key factors: the overall momentum of the stock, any upcoming catalysts or news events, and how much liquid capital you have available. It's important to manage risk carefully. Our ultimate goal is to take home a profit each day. Sometimes that means working your original trade back into profit, and other times it may be more effective to pivot in the opposite direction. The flexibility and discipline to make those choices are what make you a better trader over time. Now let's explore one more scenario. Suppose NVIDIA continues to drop, and there are no earnings calls or bullish news on the horizon. Let's imagine that the Federal Reserve announces rising inflation concerns, which sends the market into a downturn. In that case, it would be wise to hold off on averaging down immediately. We'd want to wait for that drop to play out more fully and hit a more aggressive bottom before adding another position. This allows us to maximize the benefit of the price discount. For example, if we originally bought one contract at $400 and the price dropped to $100, we could buy a second contract at that steep discount. Our average cost would now be $250, significantly lowering the break-even point. And if that decline happened quickly, over 24 to 48 hours, we'd likely see a strong bounce back, thanks to the rubber band effect. This is where patience and discipline pay off. The better you time your dollar cost averaging entries, the easier it becomes to return to profit as the stock recovers. Now let's look at a real-world example to reinforce these principles. Take a look at NVIDIA on the day of its earnings call, the night afterward, and 48 hours following. We'll explore this in a live trading session in an upcoming video, but it's a fantastic case study in dollar cost averaging. On the morning of the earnings call, NVIDIA started the day at a low of $139. Keep in mind, the last time they had an earnings call, the stock actually dropped. So this time around, there was significant uncertainty. Traders weren't sure if the stock would soar or sink. As the day progressed, NVIDIA rallied back up, and after the earnings call was released, it peaked at $145. But then something surprising happened. The next day, it dropped back down to $138. There were no new headlines, no negative catalysts. So why did it fall? The answer is simple: dollar cost averaging. Many traders had purchased puts in anticipation of a negative earnings result. When that didn't pan out, those traders began averaging into their positions by purchasing more puts to try to bring them into profit. The stock price sank not because of news, but because large-scale traders needed it to. This is the kind of activity you won't hear explained in the news. No anchor is going to walk you through the strategy behind these price moves. But as a scalper, this is exactly where you want to be. In the middle of it all, picking up quick profits between the moves of the big brokers spending millions. We're not trying to beat the entire market or analyze every chart to death. We're scalping options, grabbing value from the natural swings that occur when massive players move the market. Stay sharp, follow the momentum, and keep building your skills, because now you're seeing the game for what it really is. Remember that while we don't want to cause analysis paralysis by trying to overthink each position, it's still a good idea to keep watch of any news or event that may be causing the stock to move a certain way. If a major event like a war, tariffs, or anything else happens that can affect the direction or at least the momentum of the trade, we want to be aware, but we don't need to spend a lot of time dissecting it. TradingView has a great database of news and upcoming events that may act as catalysts, causing movement one way or the other. We often won't know which way the news will push the stock. We just know that volatility is likely, and volatility is exactly what we're looking for. It's what creates opportunity. We don't need to predict direction perfectly. We just need movement. That's the core of scalping options. So as always, keep your indicators close, stay aware of upcoming events, and trade with confidence. You've got the tools. Let's use them. These are the recent headlines. Nothing to see here, but we do see a sense of optimism in the headlines. That's a good sign for our position. Let's get back to our charts. We see a crossover in our MACD. This typically signals a shift in direction. It's an encouraging sign that the downtrend may be coming to an end. Alongside that, we're seeing a new emergence of buying activity, as highlighted by our volume indicator. This supports our original analysis and confirms that while our timing may have been a little early, our directional bias remains strong. What's particularly interesting here is that we're now seeing the bid-ask spread begin to widen. This is a direct reflection of increasing market momentum. When the ask starts to rise and meet the bid, it means that buyers are stepping in and accepting seller prices rather than sellers chasing down buyers by lowering their price. This tightening of the spread introduces greater volatility, and that's an opportunity. A volatile spread usually means momentum is building, and that kind of movement is exactly what we want when we're looking to exit for profit. The shift we're seeing in these indicators suggests that we're on the cusp of an upward breakout. Let's stay sharp and watch for confirmation in the next few candles. Now, as we continue monitoring the charts, we notice the volume indicators showing signs of weakening in the buy cycle. This softening in green volume bars doesn't necessarily mean the cycle is over, but it's worth noting. Still, green volume outpaces red, and our MACD remains on the right side of the crossover, indicating we're still trending in the right direction. Our supertrend indicator, however, continues to flash red, meaning the overall sentiment from level 2 options data still favors sellers. When we inspect the level 2 screen, we can see heavier order blocks on the left-hand side, the bid or sell side. Yet despite that, the stock is showing upward momentum. This often points to a scenario where the sell cycle is weakening and may soon flip into a strong buy cycle. These are the moments we pay close attention to, because this setup could precede a sharp move in our favor. Watch the candlestick wicks closely. Those tails can tell us a lot. Long wicks at the top or bottom often signal price rejection in that direction, which can help us anticipate the next move. At this point, our market price is slightly above our trade price. That means we're officially in profit. Great job. But let's not settle for a small win. We bought 2 contracts at $5.51, using around $1,100 in capital. Our goal is to earn at least $50 from this trade. Remember, our contracts expire next Friday, and Theta will eat away at value each night. Now imagine we waited to average down until the contract was worth just 80 cents. At that price, we could afford to buy 10 more for only $800. Combine that with our original 2 contracts, $1,102 total, and we'd have 12 contracts at an average cost of about $1.59 each. That's the power of dollar cost averaging. But we don't want to drag things out. Let's stay focused on locking in daily profits whenever possible, rather than holding and hoping. Not everyone has the ability to monitor the market all day, and that's okay. That's where the limit sell order becomes your best friend. If you have a target price in mind, you can set a limit order to automatically sell when your option reaches that value. For example, if your goal is to sell at $5.70, you can place a limit sell at that price. With an average trade price of $5.51, that would give you a profit of 19 cents per contract. Multiply that by 2 contracts, and you're looking at a $38 gain. Just make sure you set the correct quantity when placing your order. If you want to sell both contracts, don't forget to adjust it. And remember, you can always cancel or modify the order later if your plans change. It's a great way to stay active in the market, even when you're not in front of the screen. We're seeing a strong upward move in the stock price, which is great news. Interestingly, our super trend indicator still shows we're technically in a selling phase, but that can actually be a positive sign. When price action rises, even while the super trend remains bearish, it often suggests an upcoming reversal. Our MACD is still pointing sharply upward, reinforcing the bullish momentum. Buyers are stepping in aggressively now, and as a result, the bid-ask spread is narrowing in our favor. This means we're likely getting better execution prices. Since we've reached profitability and our goal here is to walk through a full example, including dollar cost averaging and exiting with a gain, this is a perfect opportunity to sell. Let's close this trade while we're in profit and lock in the win. Before placing your sell order, make sure to adjust the quantity to reflect the total number of contracts you're holding, unless you're intentionally keeping some open to ride further gains. Splitting your exit can be a smart strategy. You secure partial profit while giving the remaining position room to grow. Just know your plan ahead of time. By default, most trading platforms, including Thinkorswim, use FIFO, first in, first out. This means the system will automatically sell your oldest position first, followed by the next in the order they were purchased. Let's go ahead and place a limit sell order at $5.65. This ensures we won't sell below that price. If filled, that gives us a profit of 14 cents per contract. With 2 contracts, that's $28 in total profit. That's nearly halfway to our $50 daily target on our very first trade. Great work. Here we can see our profit and loss for the day showing $29, slightly above our target. This can happen if the momentum pushes the fill price above your limit order. Don't worry, this always works in your favor. A limit order never executes below your set price, only at or better. What's our next move? Simple, let's buy another call. We're seeing strong upward momentum, and all signs suggest the stock still has room to climb. This is a great opportunity to use some of our remaining capital and open another position. This time, instead of relying solely on chart patterns, we'll keep a close eye on the Thinkorswim mark and trade prices. These values let us monitor the profit or loss of our position in real time, without needing to constantly analyze the charts. It's a smart way to stay informed and ready to act. Looking at our Level 2 options data, we're seeing large buy-side order blocks, an encouraging sign that buyers are stepping in with strength. This should help push our position higher in value. Now let's take a look at gamma. For this particular call option, the gamma is 0.0283. This means that for every $1 increase in the underlying stock price, our delta will increase by approximately 0.0283. As delta increases, so does the sensitivity of our option's value to the stock price. In other words, the more in the money the option becomes, the faster it gains value. Keep in mind, delta maxes out at one point. Why? Because an option represents 100 shares of stock. So if you were to exercise the option and actually buy the shares, a $1 move in the stock would translate into a $100 gain. For example, if you purchased 100 shares at $10 and the stock rose to $11, you'd profit $1 per share, $100 total. That's what a delta of 1 reflects, dollar for dollar movement multiplied by 100 shares. What if we wanted to purchase an option with a much longer expiration date? Let's take a look at the 21st of November, 2025 options. If we stick with the same strike price of $135, that call would cost $18.95, or $1,895 per contract. That's a big jump in price compared to the shorter-term options we've been working with. The benefit? You get a significantly longer time horizon before expiration, essentially buying yourself a large cushion against short-term volatility. This long-dated option still has a delta of 0.50, meaning it behaves similarly to our current call in terms of price movement. But notice the theta. It's only 0.05. That's because time decay happens much more slowly when there's a lot of time left before expiration. Think of it like reserving a room at a hotel. The longer your reservation, the lower the daily rate seems. But when the expiration date hits, that's checkout. There's no value left in the option. So while you're paying more upfront, you're also getting much slower time decay in return. Let's go ahead and set our sell limit now that the value of this contract has risen above our trade price. We entered the position at $5.68, and we're now seeing the market value reach $5.80, putting us up by 12 cents. That brings our total profit for the day to $41, getting us very close to our $50 daily goal. To try and capture a bit more from the momentum, we'll set a sell limit at $5.85. If that hits, we'll earn a $17 profit on this contract, pushing our total to $46 or more. On the options chain, you'll notice our position is marked by a small green flag, and just below it, a small red S. That red S indicates a sell order has been placed on this position, giving us a clear visual cue that we're actively looking to close the trade. And just like that, it's gone. That can only mean one thing, traders. Our position sold at the price we wanted. Looks like we've successfully wrapped up our trades for the day, locking in a total profit of $46, $29 from our first trade, and $17 from the second. Not bad at all for a single trading session. There's still strong upward momentum, so let's go for another call. This time, we'll spend a little less by choosing a strike price that's slightly further out. We're buying a $137 call for $490. Take note, the delta on this option is a bit lower than our previous trade, which makes sense since it's cheaper and further out of the money. We go ahead and set our limit order and wait to see it appear in our open positions, but nothing happens. Let's check our Messages tab to figure out what's going on. Rejected. Uh-oh. Let's try again. Rejected again. What's going on? Let's dig into this and figure it out. Let's head over to our Balances tab. Take a look at settled funds. See how it's less than $490, the price of the option we're trying to buy? That's the issue. We only have $327 in settled funds available, which isn't enough to cover the purchase. And that brings us to a very important lesson. Options settle the next trading day. When you sell an option, both the amount you originally spent and the profit you earned won't be available until the next trading day. That means when you're buying and selling options throughout the day, you're using up your available liquid capital. This is a key concept to remember, especially when it comes to dollar cost averaging. If you see one of your open positions drop significantly in price, you may want to buy more to lower your average. But to do that, you need funds available right then. If you don't have the capital available on the same trading day, no worries. You can wait until tomorrow, when your funds from today's trade will settle and become usable again. And remember, thanks to theta decay, if the stock doesn't move, that same position will probably be available at a discount tomorrow anyway. That wraps up our session for today. Great work. Let's do a quick recap of what we accomplished. We walked through buying our first call option, saw it go in and out of profit, learned how to analyze our indicators like VWAP, MACD, volume, and RSI, practiced using dollar cost averaging to improve our break-even point, placed a sell limit to lock in profits, and learned an important lesson about settled funds and why timing your capital matters. All in all, we walked away with a $46 profit and, more importantly, a solid understanding of the flow of a trade. In the next video, we're going to dive deeper. Real market conditions, live trading, and an especially important moment, handling an earnings call. Earnings calls can cause huge spikes or drops in stock prices, and we're going to show you exactly how we handle that kind of volatility using NVIDIA as our live case study. You're doing awesome so far. Don't worry if it all feels like a lot. Every video builds on the last, and every trade teaches us something new. So stick with it, keep reviewing, and we'll keep moving forward together. Now, let's keep going and take your trading to the next level. See you in the next one.